In one word, yes, you have to be very selective. You have to rotate according to the cycle. You have to look at your credit quality, and also you have to think about duration. So fixed income valuations today, they pose a real challenge to investors because the levels are very close to historical lows if you compare to 2008, both, from a spread and a yield perspective. Nonetheless, we remain constructive on selective risk assets in the fixed income space, expressing, that view across corporate credit markets, and by using our strong proprietary underwriting model, and then deploying a very nuanced allocation to select credit instruments. This is where you can make a difference. So what does this mean? This is a focus, which continues to be on basic industries, capital goods, energy, and other cyclical sectors in both developed and selectively emerging markets. And we favor industries that have a cyclical tilt, like autos, mining, and they could see a marked improvement as the economy rebounds from the lockdowns. But we also have to be very mindful of the risks, we discussed above around tightening monetary and fiscal conditions. Here, we should also think about ESG. There are some ESG leaders in these space, which are improvers, where also you can find some very good value. And similar to last year, we also believe that higher quality assets offer a better risk return profile, and they should remain supported even if there's a risk around monetary policy. So we are generally avoiding both ends of the credit quality spectrum, with high quality offering limited total return potential, and lower quality bonds still, susceptible to some hiccups in the global economic recovery. And finally, also to think that you have some very good companies out there in the market, which are dominant, which have pricing power, which means that if you still have inflation risks, they can pass on those price increases to their end clients.
So these are potential winners of 2022 on the fixed income side, if you will. What do you expect are going to be the losers, or which instruments in particular would you not recommend at the moment, let's say?
That is also, we just want to be mindful of avoiding certain things. And as much as we see pockets of value, for example, in pro-cyclical corporate credit. So the economic conditions generally should remain supportive of credit spreads. And we anticipate, that we will have minimum defaults across global credit assets. And while they may not rise, to the extent of 2021's record-breaking year, corporate profits in 2022 should continue to surprise to the upside, and especially in the first half of the year. Now, there are two strong tailwinds working in favor and supporting the market heading into the new year. First, supply constraints, and we've seen this, may have peaked, which would relieve cost pressures across multiple sectors. Those corporates, those firms, have to reorganize their production, their distribution, which they're doing right now. Secondly, companies continue to exhibit a high degree of pricing power because you have the strong demand of consumers. So consumers in aggregate possess an enormous amount of savings, which they're ready to deploy as the economy continues to renormalize. If you think about it, the American consumer, there is $2 trillion of cash sitting on the side, and this can have a major impact in terms of consumption. Then the second half of the year for 2022 becomes a bit, it is less clear as the global central banks may become less accommodative if inflation persists. So you want to see this rotation with the central banks, pulling back their support, stabilizing things, and keeping an eye on this. So, general picture, finally, we're shorter duration in terms of our risk assets, and we would generally avoid going long duration in our corporate portfolio given the hawkish stance of the Fed.